Okay, so let's discuss bull call spread. Right now, currently Nifty is 10,360. We can look at the Nifty here, and this is 10,360.40. So let's leave it, give it in the round figure. And as per the bull call spread theory, it says one of the most popular type of spread is a bull call spread or bull spread, and this can be created by buying a European call option on a stock with a certain strike price and selling a European call option on the same stock with a higher strike price. Okay, so we are buying a lower strike price call and selling option which is higher in strike price. So instead of taking index, we can take stock also. So let's say you want to take TCS. So you go for TCS. Now the TCS spot price is 29.43. So let's go and write it here, TCS and 29.43. So this is the spot price, right? And now the strike price is set, then we have to, in this strategy or theoretically, what I'll do, let's write it down. Buy what? Call European, or I can buy call CE. Buy call European with a lower price and sell call European with a higher strike price. Right? So this is the strategy. So let's suppose the spot price of TCS was how much? 29.43. Okay, and we're looking for calls. So if we see this option chain, in the center we have the strike price in between. Okay, and on the left hand side we have call, and on the right hand side we have puts. So if we talk about calls, the LTP column will tell you about the current premium, and the bid price and the ask price will tell you the offer price or the premium. So normally in the market you will see that bid price is 49.50. So somebody wants to buy at this premium and somebody wants to sell at this premium. Okay, the option. So there is a spread somewhat. Now, so likewise we talk about puts, we have the premium for buying is same as 10 here and 10.45 for the same strike price of 2900. So it says that to create a bull call spread, normally we buy a lower strike price and sell a higher strike price call. So why we do that? Because higher strike price have lesser premium. Now let's read it. Both options have the same expiry date, and the strategy is stated in figure 13.2. The profit from the two option positions taken separately are shown by the dashed line, and the profit from the whole strategy is the sum of the profit given by the dashed line and is indicated by the solid line. We'll explain that. Because a call price always decreases as the price increases. So it says that as a call price always decreases as the strike price increases. So higher the strike price you go. So let's say this is out of the money. The premium you will see here is reducing. So the price is 29.50, the premium is 20. 3,000 premium is 8 rupees. 3,050 premium is 3 rupees 65 paisa. So this becomes out of the money. So more out of the money you go, lesser the time value you have and smaller the premium you have. Okay, so the value of the option sold is always less than the value of option bought. So I can write here that the premium of call European bought is always greater than the premium of call European sold, right? Or you can write that the premium of call European bought, premium of option sold is always less than the premium of call option bought. Both are the same thing. Now the value of the option sold is always less than the value of option bought. So a bull spread, when created from calls, therefore required an initial investment. Suppose that K is 1 in the strike price of the call option and K2 is the strike price of the call option sold, and ST is the stock price of the spot expiration of the option. So K1 is the strike price of call option bought. So let's suppose K1, so call we purchase, it's a strike price. So let's suppose we purchase, let it be K1 is call buy and K2 is call sell, right? So the strike price and the premium, I'll write it later on. So it says that, and the ST is the stock price on the expiration date of the option. So ST is the spot price on the expiration date of the option. Okay, so this is, let's suppose S0, okay, and we have to see the ST of TCS, okay, on the date of expiry. So this is, I can write on 1st January, and let's suppose what is the expiry date? We can see here it is written 22nd of February 2018. So 22nd, so let's say this is today is 28th of Feb and expiry is 22nd of Feb. So figure 13.1 shows the total payoff that will realize from a bull spread is different circumstances. If the stock price does well and is greater than the higher strike price, the payoff is the difference between the two strike price. So it says that the price do great and the higher strike price greater than the high strike, the payoff is difference between the two strike prices. Okay, so remember this thing. It says that if the spot price does well and is greater than the higher strike price. Okay, so here let's say take an example. If the ST is greater than, okay, the K1 when the strike price is higher. So let's take case the strike price we have taken here is, let's say anything, let's say 2900, and the premium for that is 49, and we are selling it for, or let's say let's take 2950 and the premium is 20.80, keep it 20, and let's say take 3000 strike price and the premium here is 8 rupees 80 paisa. So 8 rupees, let's say keep it 8 rupees. This is what on 22nd of February, right? And 22nd, and on 22nd of 20th February and 22nd of February, what happens is, let's suppose, I'll paste it here, just like that, I'll correct it. So if the spot price is greater than K1, okay, so let's suppose the TCS spot price here is more than the K1. So K1 is 2950, so I keep it 2980. Okay, so as per the theory, it is greater than, higher than the is greater than this higher strike price. Okay, so price does well and is it greater than the higher strike price. The payoff is the difference between two strike price, K2 and K1. So what will be payoff now? Let's take the premium here. What should be the premium on the date of expiry? The time value will be 0 and the intrinsic value will be how much? This is what you paid and this is what you received. Now, so you have purchased this thing, so you're gonna sell it here to close your position. So what would be the premium here? So you purchase this 29.50 and the price went to 29.80. So premium will be spot minus premium will be intrinsic value plus time value. Time value is 0. So spot minus a strike will be your premium. So here your premium will be spot minus strike. Right? So 30 rupees is you're gonna receive, and when you close this thing you have to buy. So now what happens is call to the K2 call, you sell it, sold, you have to purchase it. So when you purchase it, you have to pay premium. Now what should be the premium? Now time value will be 0. And if you talk about the intrinsic value, then max of, very simple, put the formula, max of spot minus, so the spot minus strike, okay, or 0. Right? So here the premium will be paid will be 0. So the difference here, what was your difference here? What were your net expenditures? So you can say net cost the premium paid, here is this plus this. So 12 rupees you paid here. Now here will be 30 net premium paid, right? So what will be your profit? This plus this. Simple. So your net profit becomes 80. Okay. Now, so as the question says in the example, the net payoff will be the difference between two strike price, K2 minus K1. Now what is the difference between these two strike prices here? 50 rupees. Now that shows that is the payoff. Okay, so payoff and profit is different. Okay, so what should be the payoff here? If we talk about now payoff, you remember that was the max of spot minus the strike. Okay, and hold on for a second. So max of spot minus the strike or 0, that is the payoff, right? Now, so we were a little confused here. So it says that the price is greater than the higher strike price and the payoff is difference between the two strike price. So K2 minus K1, okay. So the difference between two strike price or K2 minus K1. If the stock price on expiration date lies between the stock price to strike price, the payoff is ST minus K1. So we took example of second one instead of the first one. So here the spot price is almost 29.80, okay, and K1 it comes to 29.50. So the difference 30 is the payoff. So in the first example is, so instead I can correct if the ST is greater than K1 but less than or same as K2. Okay, So instead, if the ST is greater and same as K2, greater or same as K2, in that situation, okay, the payoff will be K2 minus K1. So which means if this is 33,000, the payoff will be 50. Okay, so payoff is 50. That means 3,000. Okay, and minus, you can say the spot minus the K2 minus K1. The difference is 50. The same thing will be your payoff. Okay. However, if we take it another way, let's suppose if ST is greater than K1 and less than K2. Okay, so which means let's suppose this is 2, 8, 980. Now in this situation, the payoff will be 30 and the profit would be 18. Okay, and in this situation, the profit would be around 38. Right? So here, if ST is greater than K1 and less than K2, so ST spot means that the expiry price, okay, so the price on expiry date, spot price on the date of expiry is greater than, okay, the strike price, lower strike price call option, and less than higher strike price call option. Okay, so in between anywhere, the payoff would be, you can say simply, the payoff would be equal to ST minus the K1. Okay, and in this situation that comes to 30. Okay, so the expiry date price minus the lower call option. And if it is same as K2, okay, so that means then the maximum payoff would be the payoff would be equal to K2 minus K1, right? Now there could be a third situation where if third condition is, what if the price increases? Okay, what if the price increases beyond 3,000? So let's say the price goes to 3,200. The spot price goes to 3,200. Now, so you have to pay this much. So I have to put a minus sign here. Okay. So you have to you'll get almost 250 rupees as premium here, the intrinsic value only on the date of expiry. So the difference between 3,200 and 2,950, 250. And if we talk about this 3,000, it went above, right? So spot minus a strike, the formula max of spot minus a strike or 0. But because you have sold, so we actually paid this thing, so put a minus sign here, so 200 is gone. So if you have purchased, if you have purchased, so you pay premium, so 200 rupees is gone here. Okay, so 200 is gone and 250 we have received. The difference 50 is my net payoff. So that is basically the, if the payoff is greater than or same as K2. Okay, so your payoff will be always K2 minus K1, so that would be 50 only. So in case if the price is higher than the K2, okay, the higher strike price, okay, so the higher strike price is 3000. So if it is greater than 3000, okay, the payoff will be always difference between K2 minus K1. And if the payoff is in between, the difference between spot price on the date of expiry minus the K1, and if it is higher, then it is always K2 minus K1. However, if you notice carefully, the profit is 38 in case of 3000 also, and profit is 38 in case of 3200 also. If you increase it even to 5000, the profit remains the same. Why? Because call buy will give you profit and call sell will give you losses, because if the price increases, the call sell gives you losses and the call buy gives you profit. If the price goes down, then call buy gives you losses. Okay, that is the amount of premium you paid, that is the maximum loss you have. And if the price goes up, it gives you unlimited profit. So you can think like this: one is giving you profit and another will give you loss if the price goes up. So you have limited, profit upside. And likewise, if the price goes down, you have limited profit downward side or limited loss downward side. Why? Because call buy will give you limited loss and call sell will give you limited profit. So net would be your limited loss. So you have limited profit and limited loss in both the directions. Okay. So in this example, let's suppose if the price goes down, we go further here now. So to fix this thing, the premium paid. Okay, so I want to put a formula also here. Max of, I didn't put the formula in the beginning, max of spot minus the strike price or 0. Okay, this is the formula here. Now let's suppose if the price goes down, how much? Let's say 2800. So my loss is 12 here. The maximum loss is 12. It goes to 2900 and still loss is 12. Let's suppose it goes to 2000. My loss is still 12. Why? Because call will give me a loss of the premium I paid, so that is 20, and put will give me a profit maximum of 8 which I received in the beginning. So my net loss will be 12. Okay, in any case, if the price goes below 2950, even it is 2950, I'll have a loss of 12. But even if it increases 1 rupees, let's say 2951, I may have lesser loss. So you can say the break even comes to 2962. Right, now this is a covered call, this is a bull call spread. So we are trying to make some money from the spread, expecting that the price may not go beyond 3000. So if price does not go beyond 3000, I'll get a profit of 8 rupees here. Okay, and it goes beyond 3000, I'll have a limited profit of 38. Okay, but because I analyze the market, okay, and I know that in a month it will not go beyond 2-3% up or maybe 5% up. So till that limit, let's say I believe the price will not go beyond 3100. So what I'll do is 3550. So I'll sell this one instead of selling this one. So I look for a contract where I believe that the market will not go beyond this point. So this gives me a little extra premium. Okay, and that reduces my total cost. So if I buy only call, I have to pay 20, and if I buy call and sell a call, I have to pay only 12. So I receive it, so that reduces my total cost of getting into this contract, right? Let me explain you the payoff chart. So take the pen here, and you can see here the short call payoff is created by this dotted line. Okay, so you check this thing. Right, so this, oh, I'm drawing a little writing with this pen, so let's forget about the pen. So this is the short call strike price. Here you can see dotted line. So it shows that you have limited profit if the price goes down and unlimited loss if the price goes up. So this is the payoff for short call. Now we talk about the long call payoff. So that means you purchased a call. So if the price goes up, okay, so you have unlimited profit. So one is giving you unlimited profit and limited loss, another is giving you limited profit and unlimited loss. So instead of this, we get this solid line in between. So which suggests that you have limited profit and unlimited loss. So let's open PowerPoint to explain you better. So this is your payoff chart. So this is your price line, and this is your profit, and this is your loss, right? And if in this direction the price increases, and in this direction the price reduces, right? Now, so what happens is, if you talk about the payoff of a call, this will looks like this. We have already explained this thing. And if you talk about the payoff of a call sell, so this is call buy, this is payoff of call buy, and this is call sell. So what happens is, if the price increases, the call gives you profit, the buy call or the long call gives you profit. If the price goes down, you have limited loss. Same way with the call sell. So you short call, so you are selling a call, so you have a limited profit if the price goes down, because buyer will not come to exercise. So premium is your maximum profit. And if the price goes up, you have to deliver the good, you have to purchase it any cost, you have to deliver it, so you have unlimited loss. So if you combine these two strategies, then this will give you look like this payoff chart. So you have limited losses if the price goes down, and you have limited profit if the price goes up. So very simple. If you're looking at the payoff chart, you can figure out what will happen if you are getting into this strategy.